Today's webinar will be recorded, and everyone who signed up will receive a copy of the recording by email over the next couple of days. We'll save the last 10 minutes-ish for a live Q&A. So if you have any questions, feel free to pop them into the Zoom Q&A box. You can find it in the Zoom panel, and we'll do our best to get to all of the questions as they come in live. Before we get started, there's a quick tool so we could learn a little more about you. So you should see a pop-up on your screen, and we'll give you a couple minutes to respond before we share the results. Okay. So please go ahead and respond to that poll. Okay. Okay, so it looks like we have half of our attendees responded so far. 20 more seconds. Hey Neil, you doing okay there?
Yep, all good.
All right, cool. All right, fantastic. Wow. So Neil, 57% of our attendees are actually exploring. 29% the organizations are not yet considering AI. And 14% of our attendees have already adopted AI, but just within the last 2 years. Fantastic.
I'm really looking forward to the questions that everyone is bringing forward. They're at a great stage. I'm hoping that some of the earlier adopters can also take the lead with some really solid questions based on their experience.
Oh, that'd be fantastic. Okay, great. So let's jump into today's presentation, guys. I'm excited to have Neal Silbert. Neal is the GM of Insurance at DataRobot. He leads DataRobot's insurance business, working with data scientists, actuaries, and business analytics professionals to deploy machine learning in underwriting, claims, and servicing to improve the profitability and efficiency of business decisions. Prior to DataRobot, Neal has more than 25 years experience across the insurance industry. So Neal, I'll pass over to you now.
Excellent, thank you. All right, I'm going to be sharing my screen and moving into presentation mode. Can someone confirm that I'm coming across okay on the microphone?
Looking good, Neal.
All right, can everyone see my my insurance page here, my entry page?
Yes.
Wonderful. Well, first thing, I'd like to thank Leslie and Racine, our very important partners to DataRobot, and have been incredibly professional, amazing partners to work with. So we're quite excited to have this partnership going, and we're grateful that all of you are here to talk and meet with us. As we go through our slides, please feel free to put questions into the chat area, and we'll work our way through them. All right. So here a little bit about myself. Leslie was quite kind enough to introduce me. I've got more than 25 years. It's starting to be closer to 30 years, which I'm kind of dreading because it just sounds like such a big number of work in the industry, both on technology, operational transformation, as well as product management and analytics. I first started doing analytics in the late 90s with AI. Prior to that, I was doing more traditional forms of analytics. The first real hardcore insurance product I really had was claim settlement optimization in 1991. And shortly after that, I started getting into rating engines for premium rating. So I've been in the industry a long time. I've probably touched, worked with, integrated with, took data in or out of every major system. Oh, and probably even broke every major system in the industry. So with all that said and done, for the last 12 years, I've been working deep in the industry, specifically in several cases with software vendors, with SPSS, and then with IBM, and then back out in the industry as a senior executive with Zurich, where I was in the product management organization. We had a team of more than 50 data scientists and actuaries creating risk segmentation, pricing analysis models, claims analysis, and optimization. And I was the first business sponsor for counter fraud models built internally. I was also one of the first business sponsor for cognitive underwriting as well. Phenomenal company to work with, great people, and it was a great experience and really has helped inform a lot of my thinking today. So for our agenda that we're going to go over, we're going to cover a number of items. First is we'll level set on what is automated machine learning. The marketplace is rather chaotic with many different vendors trying to establish an audience. This can create quite a bit of confusion. We'll talk a little bit about DataRobot. We'll go over some common insurance use cases, some roles involved in adopting AI. I think that'll be important for everyone here. And then in terms of next steps, I don't think we'll be able to fit in a demonstration of DataRobot, but I have some extremely exciting demonstrations I'd like to share and show. So that would probably be a follow-up webinar that we'll schedule. Also, Leslie has been talking about an AI for executives class, which is amazing. Should timing work, I might be able to help teach. It's an amazing class, and we find that our clients are strongly enabled to understand how AI can improve their business, but also imagine what solutions they can do for their company that help them get their business strategy moving forward. So one of the things that's quite important with AI is what does it all mean? When I first started touching computers in the 1970s, people were literally building them, and more about computers were wiring things together. And it was all fundamentally about capturing information, generally on some kind of transaction, a buying or selling of something. Then we started moving into data warehouses where we summarize those transactions and try to show what happened over time. Then slowly and gradually, we started doing more and more analysis on them to the point where we are today, where the true value isn't capturing the transaction or reporting on it. It's helping make a better decision moving forward. So Andrew, he was the chief scientist at Baidu, one of the largest internet organizations. He really feels that the impact of AI is as transformative as electricity was. When I look at the insurance industry and see how many hundreds of opportunities there are to make much better decisions, I feel compelled to agree. Another study came out from McKinsey. This one I found particularly interesting is that the leaders the leaders in AI would overcompete against their competitors by 1 to 5 percentage points. I think that's really critical. We'll get to some points where we'll talk about the difference in pricing benefit from AI versus non-AI, and that'll validate and prove this out. Another study from Forrester felt that AI-driven companies will take 1.2 trillion per year from their less automated clients. I think we're actually seeing that already with some of the business that Amazon's helping eat up. Some other facts that are interesting, 81% of all companies are already using some form of AI. 60% spend more than 5% of their budget, and 19% are actually spending more than 20% of their IT budget on AI. I think we'll continue to see more and more of that done. I think board of directors should begin asking, why are we spending so much money on infrastructure if it's not helping make better decisions? And that's what's going to drive that shift into the AI space. Now, DataRobot exists because the availability of raw talent and people simply does not exist to meet the demand. At Zurich, I had a very, very large team. It was a great experience, but it's hard to grow a team much larger than that. Not many companies are able to have extremely large data science teams. Certainly, it favors very large companies with very big budgets. Smaller companies are even more challenged as to how they're going to acquire the people with the skills. Once you get into a large company with a lot of people, you become a target for recruiting, and people tend to get recruited out of your company as quickly as they get hired in. So we're really challenged to grow data science organizations. What can we do? Well, with DataRobot, we emphasize two things. One, because we are the founder and creator of the category of automated machine learning, we want to increase data science productivity. If you're fortunate to have data scientists, these are the people that are the most technically able to build these models by scratch. In an automated world, their role evolves and they grow even further. They become guides, coaches, mentors. They help plan. They take on the most difficult tasks, and they also have a governance role to make sure that the models are being used well. However, inside insurance, which is a very quantitative industry, we actually have many, many different roles that are suited and can help with data science. These are the citizen data scientists. These are our actuaries. They're incredibly mathematical. The profession itself has been doing aspects of data science, like using generalized linear regression models for pricing for almost 24 years now. So we want to help them catch up and use some of the latest technology to do even more. We have risk engineering, safety engineering, loss engineering professionals who are very quantitative. They are just dying for the opportunity to take advantage of automated machine learning. That area is one of the areas of the insurance company that actually makes data and information. And if we can empower them with advanced learning tools, it's even better. Now, why am I naming quantitative underwriters, actuaries, um, claims analytics, safety or loss engineering? Why am I naming them? All these areas don't have necessarily a formal data science background. I should have also included marketing as well. But what they do have is a quantitative leaning and an interest. And because there's so much automation in DataRobot, they're able to actually produce and build machine learning models. They may not have the formal training that a data science might have, where they've done several years in a graduate degree, but the automation will prevent them from making major problems. It will guide them and it will help them get things done. We even have clients that have no data scientists at all, and they're doing very, very well. And I don't want to leave the IT team out. They can also build models. A little bit about DataRobot itself. We started in 2012, yet it's 2019. And really only for the last 3 years have we gone to market. We spent the first couple of years literally building the product. We have raised almost $250 million, which is an enormous vote of confidence in our ability. We're also growing substantially every year and have a very large global client base. We have celebrated, like McDonald's, our 1 billionth model built in our public cloud. This does not even include the models built on premise by our clients. And we're seeing about 2.5 million models being built daily in our cloud. We're now a bit closer to 700 employees and 300 data scientists. We're becoming one of the largest pure data science organizations in the world. We have major releases that are constantly coming out. And as the GM for insurance, I have a great pleasure of working with and supporting additional product development so that my customers like you can get the best technology out there. Gartner has a very interesting study. It's not too dissimilar from what I had mentioned earlier, where 20 years ago, tying systems together and eventually BI putting together the first data warehouses and eventually enterprise data warehouses, then federated data warehouses, all that started 20 years ago. 10 years ago, they're talking much more about interactive visualization. We have wonderful products now that let you look into data. And they then see the trend toward automated analytics. Augmented analytics very much allows people to do things faster. You don't have to hand roll the statistical analysis, and you can automate large amounts of it, including important areas like feature generation. So with Gartner, they see it as a third major wave for data and analytics, and that automated algorithms are going to drive things, and they're going to transform how we generate business insights. You see in the marketplace other quotes that we set the standard for augmented data science and machine learning, that 40% of data science tasks will be automated. I believe as much as 80% can be. And then they talk about augmented analytics being the dominant shift in the industry from manual analytics and traditional reporting-based analytics to getting more insight to make better decisions. And it's a key driver of automation, key tasks. One of the things that's actually quite exciting, and this is all from Gartner, is that we find the combination of automated machine learning with robotic process automation amazing. RPA can bring in content where you don't have a formal integration and you can make decisions, or you can make decisions within RPA. A great example is when documents come in for claims or applications, they have to be sorted and routed. RPA might handle the movement of that and acquisition of content, whether it's from email or other sources, and DataRobot then will help decide where it's moved to. So one of the things that's often important, especially where we have a mix of participants here with different levels of growth along the AI chain, is how do I get started? Where am I? Where do I evolve to? So we often hear different expressions about how important AI is. It's going to crush you if you don't do it. Your competitors will have a 1 to 5 point advantage over the average. What do we do? So at some point, most companies want to try proof of concept and get their hands dirty and actually do it. Having been with IBM for several years and led the insurance business in the Midwest, for me, a large scale POC was something that was very time consuming to the integrations, the complexities. What I found with analytics as we moved away from more transactional systems to analytics is that a lot of the POCs could be done in a much shorter time frame to look at it. And we had great success there at IBM with that. At DataRobot, we see things that are amazingly fast, where we might work with a client for 2 to 6 weeks and have a very quick, very effective POC on a subject that could move the needle and actually produce a model that could be put into production. It's the fastest I've seen in the industry, and it's very effective at helping the organization understand how models are built. Because when we do a POC, we work with your team and teach you how to build the model. We don't just build it for you. We train you and work with you. You'll have to have someone dedicated to it, but we'll get you up and running. We had a phenomenally successful POC recently in Germany with an actuary who had never done any kind of predictive analytics or machine learning. He was up and running and produced a beautiful model that I'll talk about in 2 weeks. Solution acceleration. Usually this is taking advantage of all the automation capabilities in DataRobot. And once we've done the POC, the question is, well, now that we can get these important things done, we want to have our data scientists get more done for us, and they benefit from the automated productivity. Now that we've got the data science doing things, their ability to touch and improve parts of the business is expanding. Other parts of the business want to get involved. We have other groups with subject domain expertise. I've mentioned them, like the actuaries, audit, underwriting, claims analytics. Then we start seeing a concept of democratization, where you have groups starting their own analytics teams, and they're working with the data scientists, getting coaching. Sometimes there's governance level to make sure that they're focused on the right things, the model answers the right questions. And we see the power of AI spread throughout the company. When I've worked for larger insurance companies, and the hundreds that I've worked with across my career, generally manual analytics can suffice about 5 to 15% of the important questions the company has to get answered. In almost all cases, it's over-concentrated in pricing because that has the biggest magnitude effect on the company's performance. Wrong price, you lose money. And a lot of areas are completely neglected. That's why democratization is so important, especially when you can get your citizens, data scientists up and running and building their own models. Finally, as we extend and we go from 5 to 15%, maybe to 40, 45% with the data scientists, now close to maybe 80% with democratization, we begin developing an AI-driven company. The key to making this work is having a good success plan and working with experienced professionals to help prioritize the elements of what should be in a multi-year plan. And we work together to do that for you, or advise you on how to build it. Here, an example of some industry logos. You'll see Entuck Income, Homesite, one of the largest growing homeowners, personal lines insurers, Aegon, the European life insurance company, Domestic and General Gadgets, Marker Study, one of the fastest growing auto insurers in Europe, MACF, the French insurer, Tokyo Marine, the global Japanese insurer, the General, another big US auto insurer, Humana, the health insurance giant, Trupanion and Medical Pet, and Atlas, the managing general agency. I think it's important that, and of course, New York Life, one of the most prestigious life insurance companies in the United States. We work across the entire industry. We work with carriers, we work with brokers, we work with managing general agents and underwriters. We also work with companies that provide data to the industry as well. So we've shared a little about our platform. I think what's really critical here are some of the key points that come out with it. One, that those citizen data scientists that are interested and capable, they have a quantitative leaning, we can help them get access to and use AI to make and improve business decisions, whether it be pricing, frequency of audit, change and reconsideration of a customer, um, discussion on an analysis of customer safety data and actually producing new information. It's an enormous opportunity to empower different groups, making better claims, triage decisions, and we'll go into all those details. Um, Augmented data science is very important. We buy cars, we don't build them there ourselves. The ability to take advantage of car and drive and go to places that you need to go is very powerful, but you would never get there if you had to build the car from scratch. It's the same with data science. We've been stuck at 5 to 15%, I'd say, for the better part of 20 years. It's now urgent that we expand our capability. We have diversity in our analysis, we have diversity in our opinion and views, we have diversity in sources of data. We'll never get there unless we open the tent and bring more people in the decision process. Collaboration is a byproduct of that, where we have very easy collaboration with people building models, as well as working with IT in order to integrate those models into our business processes and systems. That's a very important point of DataRobot. We've designed it on enterprise scale to be very easy to work with. Lastly, we've instituted a very effective success model to help our customers adopt the technology, use it, have ROI impact, and have a solid plan that they can execute on across the enterprise. Now I'm going to take a different position. I'm going to talk a little about some of the challenges of the industry. These are important challenges. I think that we have to be very honest about them. Please keep in mind that my background, having come from a large global insurer on the commercial insurance space, I've worked also with large personal lines and as well as large life insurers as well, and health across the industry. On the large side, we've pretty much reached peak predictive analytics in manual analytics. We can't really hire that many more people without losing them. There's a high level of churn. We cannot take a magic wand and create data scientists, though people do that with their resume, and there are a lot of fake data scientists. But ultimately, it takes years to make a qualified, effective data scientist work, and we're not in a situation where we can rapidly add them. The demand is too strong. Once we start adding enough, we start losing them to attrition and competitors. That problem leads to an inadequacy of coverage. If you look at most companies with a heavy investment of AI in traditional manual, non-automated AI, you'll find that not a lot of their premium is actually covered by AI models. So they're, whether they're having a pricing, underwriting, or claims, there's a significant gap in the enterprise about the amount of AI coverage for good decision making. Data is fundamentally changing. It's no longer looking like the static historical data that when we were little kids, where you could fill out an insurance application on the back of a matchbook when people still smoked. Instead, we're looking at a situation where we've got sensor data in the work environment. The number of vehicles with telematics continues to increase. The automation of vehicles continues to increase in general. The number of vehicle manufacturers that have been coming to me and asking how do they work with insurance companies is outstanding. We have life insurance companies encouraging their customers to use biometric devices. John Hancock Insurer, which is life insurance, one of the largest insurers, part of Manulife. John Hancock is their brand in the United States. They now are exclusively with Vitality, And if you want to buy insurance with them, you have to commit to an active lifestyle that is going to be encouraged and monitored, and you participate in a biometric based community. The users of Vitality average more than 40 interactions a month, so it's very successful. They're a $3.5 billion premium a year with about $35 billion in active premium. They are doing a phenomenal job at getting people on board, but ultimately they made a $3.5 billion bet that they would keep enough of their clients to remain profitable and continue to grow when they went entirely with Vitality. We're going to see more and more of that. If your company is not thinking about how to manage this, you should begin. DataRobot and automated machine learning makes a huge difference in helping it happen. We see insurtechs popping up. I'm not sure about the frequency in the Caribbean. Many of them are on the broker or managing general agent or underwriter side, and they're trying to sell products to you using AI and automate the entire customer experience. The insights they're getting are phenomenal. I think they can be challenged because often, if they're not actually holding risk, they don't have the risk management and loss side of the pricing analytics. That's something that will be advantageous to carriers. AI is not easy to integrate. I've personally dealt with this. If you're dealing with a system that does not allow you to produce and deploy models from end to end, dealing with the multiple vendors and parts becomes very, very difficult. That's something that's taken care of for you with DataRobot, but is a very significant challenge. What do you do when the libraries you want to use for the particular type of analysis are not supported in your version of the Hadoop cluster or a specialty built analytic engine? Well, then you have trouble. The other thing, which is quite outstanding, is that very few companies with manual analytics have enough time to finish evaluating all of the external data they've purchased and see if it actually should be included in their new manual, in their new models. I did recently a study in Europe with 10 companies, and all of them purchased external data, hoping to find new predictors, but none of them had enough time in their current project timelines to finish the analysis. That's one thing that DataRobot can do in a matter of days. We talked about here the race with the insurtechs coming in and trying to eat the market. I think that they're a threat in the sell side of things, but in the product side, not so much. They simply don't have the expertise and the data on the loss side for pricing. Though, of course, as they evolve, some of them will become insurance companies and start to be competitors there. That's why it's really important for carriers to get into this space now. This slide is a very, very simple slide. The reason I put this here is that there's a very inconsistent understanding of what AI is, and I think the slide really answers it very easily. We take historical data and we use your insurance expertise and ours to define good questions that have an impact on the insurance enterprise. And then we use DataRobot in the middle to analyze that data and help make predictions that answer questions. Some of the key questions are usually in these 5 areas, but not always. How do we market better? How do we make better underwriting decisions, more accurate pricing? Everyone wants to avoid adverse selection. How do we handle our claims better? And how do we keep our customers happy? How do we have endearing engagement? We're going to talk about these a little more deeply. So I've condensed the 5 categories into 4. In the marketing side on the left, we look at a couple things. These are typical use cases that are some of the first things you'll want to do when you adopt AI. Some of these are done manually right now. Some of them are done with manual analytics. They just become easier, faster, more potent, able to look at key areas of interest and subsegment, and often have even better analytic results when using automated machine learning. On the marketing side, one of the first areas we start thinking of is how can you make marketing more efficient? You want to do at least 2 things. One, you want to not market to people that won't respond to your message. So that's usually some kind of propensity study to predict who will respond to a campaign or not, and then you drop the bottom half or the bottom 2/3. The other thing you want to do is not waste your resources inside your business process on marketing people you don't want to insure. So you want to pre-qualify everyone. Usually you'll borrow or take a risk selection analysis model from the underwriting side and then apply it in a more simplified way, because you don't always have the data, to your marketing lists and try to knock out the least likely to be insured prospects. Customer segmentation is also very important, where you start clustering and grouping your customers and trying to have common and more effective messaging when you do market. Lifetime value is a very important prediction. It has two components. It's usually about tenure, how long will they stay with me, and cross-sell, what products will they buy. Lifetime value allows you to prioritize both prospect, customer, and retention treatment, as well as have an understanding of where your strengths are in the marketplace. Underwriting and pricing has a couple things. I think everyone has probably heard of dynamic pricing. The simple definition of it is the ability to accumulate additional data to have a better understanding of the comparative level of risk of your customers, rather than pricing every customer in one of 10 or 3 or 5 buckets the same way. It's to use that supplemental data to make better underwriting decisions and understand the comparative level of risk within your buckets. Why is this important? Well, my former employer publicly shared that in workplace injury, there was about a 30% plus difference between the most safe risks and the average for any kind of given industry category. So that meant that a safer customer would have a 0.7 experience compared to the average, which would be 1.0. And then they found that the higher risk ones would be at least 30% more loss comparatively, and they would be what you might call a 1.3. So looking at the gap from the safest at 0.7 to the least safe at 1.3 is a huge difference in expected loss and level of profitability. That's what dynamic pricing really captures. And if you don't differentiate on your price and charge everyone 1.0, then you're subject to adverse selection. You're going to lose the safer risks who are going to go to companies that do differentiate, and you're going to win the high risks because your price is lower than the companies that differentiate, and you'll lose money. So adverse selection is an awful thing. We want to avoid it. Dynamic pricing helps us do it. Rapid rate development. Rapid rate development is incredibly important. It allows us to bring in price changes and address changes in the market and go after targeted market segments very effectively and win. I have customers that complain to me that they cannot get a rate change, not even a rate plan change, but a rate change out in less than a year. Recently, we were hired and bought, our product was bought by a large US insurer who wanted to introduce a new product to market. It would typically take for auto insurance in the US about 1.5 to 2 years. They want to get it done in far less than 6 months. So if we look at the difference in time reduction, a lot of it regulatory driven, from a 24-month period to 6-month period, that's a 75% reduction in speed to market. Similarly, in Europe, where we might see a time to market for an auto product being 2 to 4 months in duration, we have clients that built new auto pricing in 2 weeks. Again, looking at something about a 75 or 80% reduction in speed to market, or improvement in speed to market. It's tremendous. And also they did this with dynamic pricing. So they had pricing models that were at least as good, if not better, than what they were previously using. Predicted price product configuration is very special. We do it in partnership with our very important partner, Ernix, who is a pricing deployment engine. It's an option that some of our clients use, and it's a wonderful product. One of its benefits is that it helps you understand comparative rate change impact across your portfolio. One of the things that's most exciting with Ernix is that it allows you to predict what is the most likely product configuration a customer will be interested in or accept. Why is this important? Well, when we look at auto insurance, we have at least 3 considerations. One is, which coverages do you want? Some are optional, some are required, depending on your jurisdiction. 2, there's a question of how much deductible do you want? People have different ways of thinking about deductible. They don't even always understand that the higher the deductible, the lower the premium. And the third is the amounts of coverage. So we get coverage, deductible, I'm sorry, and limits. I think I repeated the coverage. So deductible, coverage, and limits. How much do you really need? If we can predict one or two ideal combinations of that at an affordable price the person's most interested in, then we help them make a faster, easier decision. This is crucial in online and e-commerce. It reduces the number of people that drop off because they're confused and they need help. And it certainly gives a help to the agents working with customers. Submission prioritization is important for commercial insurance, where a lot of the business is done manually, but also where we have face-to-face insurance with different market segments that like to buy things manually. How do you prioritize the new business submissions that came in? You might want to auto reject some that are strongly suspected of being money losers. You might want to auto accept some that are very clearly going to be a good, well-insured, profitable client. Those two changes alone can make significant impact. And one of my colleagues implemented such a system, and the economic benefit just for the prioritization and triage of underwriting was in the tens of millions of dollars. The last is risk selection analysis. Risk selection analysis allows an underwriter to have a very fair and consistent understanding of the comparative level of a risk before they go into the deeper pricing process. This might be done shortly after a submission is sent in from a broker or agent. And it really allows you to look at the comparative differences of risk. It will help with tiering and help the underwriter understand the level of effort and complexity in going into an underwriting activity with a new customer file. Risk selection analysis in many ways will help differentiate similar risks in the same product category as well. Claims handling is one of the areas where it's a very structured business process in many companies, and there are literally dozens of decisions, 20 to 35 easily, that could be improved between getting first notice of loss, final payment, audit, and then quality control and continuous improvement. Some of the ones that stand out very significantly are claims triage. What is going to be fraudulent? Do we have an opportunity to subrogate or have a third party take financial responsibility? Is it going to be a complex claim? How likely is there to be a lawsuit? Is it going to be a large claim? Can we predict the severity of this claim? These are just some of the important questions. You might have anywhere from 5 to 15 models that you could put into production and understand what's happening with a claim before anyone starts to touch it. Why is this important? This is important because it helps you get a better understanding of what the claim is really like, things that you might not know for weeks, and then you can have a better handling and better management of the claim as well as the indemnity. Outcome-based assignment has long been considered the grail in insurance operations. How do we get the best person assigned to a claim? Since we've done things manually for so long, it's very hard to consistently get the best person. They might be in a product category. They might be assigned to a large customer. They might be assigned to a specific coverage or type of injury. However, that doesn't always mean that they are the best person to address a specific claim when it comes in. With outcome-based assignment, we evaluate all the claims you've ever adjusted. We look at the outcomes and results by adjuster. And for every type of claim, and we can make them very granular or broad, we evaluate each adjuster's performance. And then when a new claim comes in, we can say, for this specific type of claim, this is the adjuster that's going to be able to get the best result. And then you can base that on availability so you don't overwhelm someone. Claims development modeling and reserving, I'll talk about these because sometimes they get confused together. We do case reserves when a claim comes in at some point. We may have an automated or estimated reserve amount before it's touched. Sometimes it's $0, sometimes it's $1, sometimes it's the average. More sophisticated systems use automated machine learning to predict what it could be. So we have less financial impact when we actually analyze it. And we can use analysis to, one, evaluate if there's anything important or how big the the claim would potentially be. That helps inform the adjuster. After the adjusters created a case reserve, I have one client who can predict the likeliness of a claim changing more than $35. I think that's pretty amazing. The portfolio reserving, I'm going to get to a bit later, but it is one of the most important innovations since we started using generalized linear regression models to statistically improve pricing in the late 90s. This is the idea that we can do bottoms-up analysis of losses to make more accurate reserve numbers. And we'll talk about that in a little bit. Engagement is all about interacting with the customer across the customer experience, evaluating how their impression and satisfaction with your company changes each time someone touches their account and works with them. It allows you to proactively make recommendations. One, detect when they're going to churn or the policy will lapse, and figure out a mitigation strategy. And if you've been tracking your mitigation results, predict the one most likely to work. Cross-sell and upsell might be either at renewal or for a new customer, and that might ask important questions like, what is this person most interested or most likely to buy? Detecting sentiment could be very useful, for example, after or in the middle of a claims experience. How interested is this customer in our company? What do they think of us? What net promoter score would they give us? And what will drive that? It's often useful for all these analyses to combine structured data analysis with unstructured analysis. DataRobot does both. This is always something that people are always asking me, so I wanted to share what some of the top 5 areas of interest are in P&C. It always starts with pricing. Pricing is a key differentiator, and it has the most stretching impact across the company. Risk selection scoring, we talked about, that is a pre-pricing activity to really emphasize the importance that, imagine an underwriter receives a new business submission, the broker calls them and asks for an indication of where it will be. The underwriter may be working on 10 different things or 50 different things, and suddenly they have to very quickly go through a file. They're disadvantaged due to time, lack of knowledge. There's an asymmetry. The broker knows a lot more about the account. How can he give or she give a rapid and effective response? Well, the benefit is a risk selection score will point out a lot of the risks and or lack of risks and inherent considerations with this account that will allow the underwriter to give a much more consistent response and indication that will be more likely to be consistent with what the final pricing and underwriting determination will be. Claims triage, automation, subrogation, very big benefits to accelerate handling of claims, make the quality better, more consistent, and subrogation is a key differentiator in top performers if it's legally allowed in your jurisdiction. Actuarial loss reserving, we'll talk more about that. That is, as I mentioned, very, very revolutionary. In many ways, it should be near the top, but is critical. That is, how do we reserve more accurately? The last is underwriting fraud and triage. It is not as commonly done as it should be. If you're being asked to insure something and some of the information is very likely not to be true, wouldn't it be nice if we could correct that upfront? And by the way, that happens almost every line of business. In life, we see slightly different lists. Mortality is a very mature science since 17th century, so their emphasis is a little different. Marketing optimization, how to market to the right people, very important. Disease state detection. Can we predict or understand for this client if they have an important disease? Some companies are so sophisticated, I have clients working on this right now, that they don't have to have doctors' medical exams or blood tests for a large percentage of their applications because they can detect disease state and relative level of health. Automated underwriting is about the ability to rapidly make those underwriting triage decisions and very quickly reject the high loss clients and very quickly accept the low loss ones. That has a material and immediate impact. It's very easy to do. Lapse prediction is critical in life insurance. You want your customers to stay with you, healthy and living. And then cross-sell. Cross-sell is often very interesting when we start looking at clients that can start buying more investment-oriented products. Now, we've had a talk for about 40 minutes or so, and the conversation has gone about innovations in the industry, what is DataRobot, and we've talked a little bit about some things that I thought were very innovative. Now, this is the first time that this is being shared globally. So you are experiencing something very special in the Caribbean. But I believe that these are the four emerging uh, advanced analytic use cases that are going to set the industry on fire. And I think that you'll find them as exciting as I do. The four of them here are some are very much things we're doing right now. Some are emerging use cases where we're looking for customers who want to be early adopters. The discussion of these use cases is generally not something I'm going to sell you about, but rather for clients of our product who want to do automated machine learning to see if they want to take the business game to the next level. These four have the highest impact on the ROI. The first is rapid product development with dynamic pricing. We've talked about that before. We're looking at a 75% plus reduction in time to market, and we're looking at as accurate, if not more accurate models. If you're still using GLMs, you might find that generalized additive models, GAMs or GA2Ms, or other nonlinear techniques will allow you to have better risk and pricing segmentation, and it's done amazingly fast. This client that wants to come to market in less than 6 months wants to build models by coverage, both constrained, unconstrained models, and semi-constrained models, so they can understand what will really happen in the market, that they can be fully legally compliant, and they can identify if there are any proxy variables in their models that behave in a way that's similar to a prohibited variable, so they can pull it out. So they can be accurate and legally compliant is very important. Individually developed loss predictions. This is the individual claims reserving that we discussed. It's very actively used in both claims, pricing, and reserving. What are individually developed loss predictions? This is the ability, traditional reserving looks at claims from a top-down perspective. We might compare them on a quarter-to-quarter basis, do an analysis. We might look at all the incurred costs for open claims, add that in. Then we might add a certain additional percentage in for cases where we didn't reserve enough money. That would be called incurred but not enough reported, IBNER. Then we might realize, well, some claims probably happened, but we might be near the end of a reporting period, or the claimant might be injured, not able to tell us, or it might be complicated. It'll be a while before it gets in. And those are the incurred but not yet reported. So in addition to having the claims that are there, we also have the claims that are there that we didn't reserve enough money accurately. Maybe we were missing information, or maybe we made a mistake. And then we have the ones that have occurred, they just haven't told us yet. And depending on your jurisdiction, there may be quite a bit of time before they have to tell you. So when we do the top down adjustments, say we look at a 6 or 8% adjustment of what we've already got in incurred costs, that 8% gives us a more accurate and helpful understanding of what will happen on a financial level. And we've been doing it for a long time. Actuaries produce triangles, they use the chain ladder technique. The problem is, how do we really effectively allocate that adjustment, that 8% or whatever the number is, across the individual claims? Some claims are going to be more serious, like a soft tissue back injury at a loading dock at a transportation company, or someone who falls into a machine and gets part of their leg chewed apart. Whereas others might be minor, a nasty cut, but something with stitches can heal and they have no major nerve damage. We can't just allocate the cost for something that might take a few days or weeks to recover from versus something that takes months or years. So there's a challenge on making that work right. That discrepancy means that our pricing becomes less accurate when we're developing all of those open claims and need a price on them. Our claims become less accurate when we don't realize the ultimate size and how big they'll be. And our reserving could be less accurate if we're using average numbers and not developing every claim on its individual merits. So I have one client that was a very large reinsurer, and they actually saw more than a 10-point shift in the more than a 10-point shift in the accuracy of their book. It was quite substantial, and they were actually highly benefited by having more accurate reserves. So any part of the insurance company that uses your losses will benefit from the accuracy. I want to strongly emphasize how much pricing does, but also when we have this understanding of improved losses, we can go back and look at individual claims and decide if their case reserve needs to change. Broker distribution optimization is very powerful. We've seen many management consulting firms move forward and ask companies to try to identify who are their top producing independent brokers and agencies and try to concentrate more business in the brokers that were easier to work with, gave them volume, and in general, the quality of the risk they brought were more profitable. In this circumstance, we're taking it to the next level by using AI and machine learning to analyze all your brokers' performance. We'll do individual loss development to look at their current claims for their current customers. We don't have to use 3-year-old data that's already seasoned and matured. And we'll predict the quality of the business they're doing with you. And then you can group them into groups that are perfect and you want to defend them. Brokers that can be improved, you want to increase their volume. They're giving you good risks. Brokers that can be improved that are giving you volume, but maybe the quality, the customers could be better, and then brokers that you should shed. And by doing this, what you're going to effectively do is improve your operating productivity, decrease the amount of time in processing bad business, and you're actually going to see improvement in your underwriting results. The last one is emerging. We have some clients actively talking with us about this area right now, and this is looking at the entire underwriting portfolio for line of business and helping a customer identify opportunities and risks. So the consumer of this could be the head of a line of business, the chief underwriting officer, someone who owns the P&L, and they might have a book of business measured in the many millions, tens of millions, 100 millions, or billions, depending on what their business is and where they are at. And they would like to get some help identifying segments where there's a challenge or an opportunity. And some of these, a product manager might look at it and traditionally try to subdivide by line of business, by state, maybe by county, a couple geographic slices, and we'll try to pick up problems. The real challenge here is that not every business problem is something that is cut and fits across a geographic line. Maybe the problem is more complicated. Maybe the opportunity is bigger. So instead of using just 1 or 2 or 3 ways of slicing the data to find out where your problems or opportunities are, we let machine learning pick and group similar opportunities together so that you have a very clear idea how big that is and how it works. So I've talked very quickly on rapid product development. The key things are a 75 to 90% reduction in speed to market or in time to market with a significant improvement in quality. We have a public video that Leslie can share with you where a client marker study, they publicly claimed they had a 1-point reduction in loss ratio. That was worth £7 million a year to them. Individually developed loss predictions. The impact of this will be measured in the millions or tens of millions of dollars. It will be felt across every part of the company. Traditional, non-automated, or manual techniques simply cannot do individual loss-based prediction very well. In order to do it, you need automated machine learning. It's fast and very effective. Broker distribution optimization. This is a combination of about 7 to 12 different models that help you get much better return from your broker network, much better quality, both in terms of underwriting profit and automation and processing. And lastly, underwriting risk portfolio, very much oriented toward the head of line of product or chief underwriting officer, whoever has the P&L. This is the tool that gives them a interactive approach to finding out where the risks in their book are, where the opportunities, and what they can do. Very quickly, I'll leave you with a case study here. We had a client who used a standard GLM for pricing. They found that when they moved to more modern machine learning, they had a significant improvement in accuracy and a 1 point reduction in loss ratio. And this was after actually having a pretty good predictive model that they built by hand. In the churn area, we had a client save more than 12.5 million euros by being able to detect which customers would non-renew. You can also do this in the middle of the customer life cycle as well, and in general, apply a more effective retention strategy or churn mitigation strategy. They had a 70 basis point improvement in their combined ratio. Everyone knows it's more expensive to bring on a new client to replace a repeat client. Manual claims processing. This was actually quite interesting. They wanted to detect the likeliness of litigation, and they were actually able to avoid 10% of that. Knowing that something will happen can help influence your decision to settle or how to staff and handle the claim with more specialized personnel. The value to this US insurer is more than $5 million. Automated fraud detection. I didn't spend a lot of time talking about it, but we always care about fraud. It's both on the underwriting side and on the claim side. People commit fraud are always changing the way they do it so they don't get caught. Being able to automate fraud detection allows you to have numerous approaches that more accurately predict the fraud that will happen, and you can depart from known patterns of recognition and find the new fraud as it's coming. Subrogation, if your jurisdiction allows it, can be very important. We've seen, depending on jurisdiction, subrogation rates anywhere from 2% to 25% of losses. Could you imagine another insurance company paying for 20% of all your losses? How would that improve your book of business? It's amazing. Usually most companies aren't ready for the volume of subrogation opportunity because they're handling it manually. And we also help them implement a prioritization model. I want to be clear. We will enable your company to do these things. When you're building your plan, we will give you good advice, such as, well, if you're building a subro model, build a prioritization model as well.
Yeah.
And
Hey,
then,
Neal. So I think we're just at the top of the hour. I'm not too sure how many more
excellent.
slides you have to go through.
Just this last one.
Okay.
These are some of the key people that are involved in helping adopt AI. If you're in the data science role and you need allies or people to work with you, or if you're a senior executive role and you need to look within your organization who can help out and participate. Chief actuary, they've been largely neglected by a lot of the data science advances because they have not been presented in an actuarial format that's easy to access. Your chief claims officer, they are a natural consumer of both claims analytics. Your VP of sales, they can benefit from the broker optimization. Your chief underwriting officer, certainly from both risk selection and portfolio analysis. And your operations officer for the customer retention benefits from optimized call center operations and actually predicting what problems people will have. So at this point, I think we'll wrap up. Leslie, I'll bring it back to you.
Hey, thanks, Neal. Thanks for a fantastic overview and presentation. We have a couple of questions. Does your time permit them still? Because
It
it's
certainly does.
okay, cool. So I'll just take two for now. So one of the questions that came in is, for a proof of concept, because you showed us tons of use cases. What typically are we able to achieve in a proof of concept within that 6-week period, and what type of ROIs do you typically look for or see?
Well, I think that customer churn is a great place to start. Also, underwriting triage models can be very good as well. We had one customer who had this 70 basis point improvement. A lot of your financial improvement will be specific to the amount of churn you're currently susceptible to. So we work with our clients, like the customer who answered the prospective customer asked this question, to help you figure out how to measure and what your economic benefit will be coming out of the POC. So you're not just going to do a POC and say the model works. You'll also have KPIs and a business case as well. Similarly, with automated underwriting triage, being able to eliminate the and auto reject the worst risks and possibly auto accept, if it makes sense, the better ones, you'll also have significant improvement in your combined ratio. And as I mentioned, we've seen clients that are able to generate tens of millions of dollars of benefit due to scale on this one.
Great. So I have a next one, and this is more my question than anything else.
Uh-huh.
I'm aware of one fully digital insurance company already that exists in the Caribbean. They're based out of Cayman Islands, and they're making quite a stir across there. How, in a space, because I'll tell you, the Caribbean really has a shortage of data scientists. In
Mm-hmm.
my opinion, I think I could count all the data scientists I know on one hand. How do these organizations get started if there's no data scientist?
Well, they just need an executive to lead the effort. Um, it's actually not hard to get started. I have a client who really doesn't have any data scientists. They're fairly large, and they've got, I think I'm guessing about 700 million in premium, to give you an idea of size. They have actuaries, um, and they brought on someone who is very aggressive in leading the push. Uh, and he's more from the marketing side, and he wants to use automated machine learning, and he wants to help push it across the industry. So if there's a senior executive, a chief underwriting officer, CEO, chief pricing officer, chief claims officer that wants to lead this, I think you can do this without having data scientists. DataRobot provides DataRobot University, where we train people and teach you how to accurately make predictions and use our tools and what common problems to avoid. We also
Fan-
provide each customer with access to data scientists so they can ask questions and learn from them on a ongoing basis.
Fantastic. And how difficult, once you've produced these models, how difficult or easy is it for us to explain them to the regulators?
Well, DataRobot has been built with a premise that it will only succeed if we can make all decisions transparent. When we have our next webinar and really give a demo, everyone will be able to see it. But some of the key things are throughout the product, we will show the lift. We will show all the variables that are used, which ones are most predictive across all the different models. We will show the comparative performance of different models. We will show we will actually show you either on a sample or for the entire book how every single customer was scored and which variables contributed the most to either a high or low score depending on what question you're looking at. So at the end of the day, you're actually able to find real life examples of how a model looks at a specific customer and makes it real and very specific. It also gives a good story to an underwriter, to a broker, or to a claims adjuster, to a customer of why a decision was rendered what way. What were the three variables that drove the decision toward one end? What were the three that drove it toward the other end? So that's very, very important and helpful. And then we're able to have, we actually produce regulatory content information. It was initially driven due to extremely heavy regulation in the banking sector by them, but it explains every single model, the math behind it, and the approaches used, and it's automatically generated as part of our product.
Fantastic. Okay, great, Neil. Thank you. So in terms of next steps, we'll send out the recording to everyone via email. It sounds like we're able to invite you back to do a demo with some real life use cases. And we'll set up some dates for that, Neil.
That would be great. We'll work together on that, and then you can email it out to everyone.
All right, super. So Neil, I want to thank you again for your time today and thank everyone for joining us on the webinar. We look forward to continuing the conversation. Have a good day, guys.
Thanks, everyone.
Thank you.